the Federal Reserve went from QT, meaning quantitative tightening, they pivoted to QE and started cutting rates. That started about September 18th or so. The first rate cut was 50 basis points. The second one was 25 basis points, and another 25 basis points, which was a couple of weeks ago. And what happened? What happened since the Fed cut the rates? The bond market is not buying anything the Fed is selling. Not at all. So one of the very few times that I can remember in my past 30, 35 years of trading, something very, very weird or something very unusual is happening. That is, Fed is on a rate cutting phase. The bond market is increasing the rates. In fact, it is shocking to me that how, the Fed rate cut versus the bond market increasing the rates is mirroring each other. So when the Fed starts lowering the Fed funds rate, the bond market usually follows. But what the bond market is looking at is much more than what the Fed is saying. The Fed is saying inflation is fine, unemployment is fine, we're getting into our 2% inflation target with full employment. Bond market's not buying it. Bond market is looking at what I've been talking about for 4.5, 5 months since I started this channel, which is the national debt at 36 trillion. In about another 75 days, we're going to be at 37 trillion. And the cost of borrowing of all that money, which is up to 1.2 trillion now. I've done multiple videos on the channel. You can go check it out. And to me, that's what the bond market is saying. Another thing bond market is saying is with the new administration, if they cut the taxes like they promised they will, I don't know how Doge is going to manage cutting spending, but what the bond market is seeing is that inflation re-accelerating. I even talked about this called stagflation, right? A stagnant economy. The reason the Fed is cutting rates, they're seeing the economy slowing down. There is no ifs and buts about it. There is no other reason for the Fed to cut rates. When the stock market is at an all-time high, when all hard assets are all-time high, including real estate, gold, everything else, why is Fed cutting rates? Fed is seeing trouble ahead. Well, what the bond market is saying is their trouble ahead is a reinvigorated or refired inflation. Inflation is not 2%, people. Inflation, when the government gaslights you and tells you it's 2%, it's not. It's running about 6-7% a year. That's due to the debasing of the currency. That's due to the printing of and spending, and the bond market's seeing it clearly. So when I talk about this, and I did a couple of videos on stagflation. Now, actually, those talks are coming around. I'm seeing a lot on Twitter what people are talking about, and this is what's happening. I follow the Kobesi letter. Please go follow him on Twitter. I'm on Twitter as well. If you do follow me, I appreciate it. I post quite a bit. So it's official. The 10-year note yield is now up 100 basis points, exactly 100 basis points since the Fed pivot began in September. In other words, while the Fed has cut rates by 100 basis points, rates in the market, now this is the bond market, the 10-year note, have risen by 100 basis points. Is this the biggest market to Fed disconnect in history? I call the segment Fed has lost control of the bond market. And if you guys can, take a look at the right-hand screenshot, it's pretty clear. So the blue line is the US 10-year note, okay? And that's what the bond market is doing. Bond market, this is when the Fed started lowering, as you guys can follow my arrow, this is when the Fed started lowering the rate, September 18th. They cut it 50 basis points, and here's the Fed funds rate right here, okay? That's the scale on the right-hand side for some of you who cannot see it. And this is the bond market rates, the actual bond market rates. Well, the Fed has cut 100 basis points. The bond market has raised the rates by 100 basis points. There is something happening here that I have not seen for a long time. And this happened in the 80s, one more time, when Fed Chairman Volcker was trying to kill inflation. And it didn't end well for the asset classes. It did not. So to summarize this, Fed is cutting rates globally. All central banks are cutting rates. They are seeing trouble ahead. But the bond market is saying our trouble that we're seeing is inflation coming back, or inflation not going to the target rate of 2%, economy slowing down. With the new administration's cutting taxes, the debt deficits are going to go higher, national debt's going to go higher, and the bond market's pricing everything correctly. I always follow the bond market, and the disconnect between the bond market and the stock market, which I'll discuss later on, is also very evident. And today, at some point, this is going to break. When I say break, I'm not talking crash. I'm not talking anything like that. What I'm talking is that when a bond market's raising rates, the stocks have to listen to it, okay, at some point. And today is last Wednesday when the Fed cut the rates by 25 basis points. We know what happened. We had a massive down leg. After that, we had a little dead cat bounce. We literally bounced back to the trend line that we broke, and now we're rolling over. So we'll see. But this is something you guys should follow. So how can you follow this? You can follow it by TLT. TLT is the 20-year inverse ETF. Look at the chart of TLT. If TLT is going down, that means interest rates are going up. So the bond market is a lot bigger than what the Fed can manage. It's trillions and trillions of dollars. Fed has lost control of the bond market. Simple, no ifs, no buts about it. And am I concerned? Yeah, I am concerned. And the stock market's going to pay attention to it at some point, because Fed is saying everything is fine, don't worry about it. Bond market is saying, nope, everything is not fine. We know what we're doing. We're going to keep raising rates until we believe that the new buyers of the debt that the Fed has to issue when the old bonds mature have to get a decent return. And that's what's happening here. And it is all due to our messed up fiscal policy, which is followed by messed up monetary policy.